Hi everyone, this is a motion debrief for UADC 2025. I picked a finance motion for today. The motion reads that we support the use of activist short selling by Western investment firms on companies in the developing world. I have also left the info slide in the document, but I'll leave you to read it for yourselves. Important development since the motion was written 2 years ago is that Hindenburg Research no longer exists. It has ended, and so not really the best for examples these days. So, big question is first, what is short selling? What you want to do with short selling is you want to borrow something, sell it, buy it at a lower price, and then return it. So, first, you want to borrow the stock and sell it, for example, for $20. Now, I could just wait for the stock price to go down. That's what a non-activist short seller will do. You'd think that the company is just not a good company, naturally the stock price will go down. But if you are an activist short seller, what you want to do is convince everyone that this is a bad company. So the most common way to do that is you publish a report. Maybe you'll publish a report saying, I think this company is poorly managed. I think this product or service that they are performing is not a good one. Or maybe something even more investigative. You looked into their financials and you saw there are these maybe sketchy things, shady things that they're doing, borderline fraud, actual crimes they're committing, and say, this is a bad company. You have to get out of it. You have to sell your stock before it completely crashes, before the government gets them, etc. Remember that you borrowed the stock and you sold it. You have to give that stock back to the person you borrowed it from. So you have to buy it back from somebody else. And your goal here is to buy it for cheaper than you had originally bought it, which is why you wanted the stock price to go down. So here, you bought it back, for example, for $15. Your profit is how much you sold it for at the start and how much you bought it for at the end. So you sold it for 20, you bought it for 15, you made a profit of $5. So you have an incentive for the stock price to go down. And what the debate is about is whether or not it is good for companies to have, or investment firms to have that incentive. And in exchange, they can publish a report that would inform the market about the nature of this company. So let's go through the various arguments. On government side, you want to explain a problem. In developing countries, there are many issues that plague corporations. The Adani Group was the particular and controversial example. However, an important thing with how we set this was that we didn't want to make this motion specific to the Adani Group. Not only do I feel like there are a lot of issues with how the Adani Group manages its company, I also think that it's much richer a debate if you think about this as an ecosystem and how it affects the financial landscape as a whole, rather than just here's one individual case and what happens with that individual case. So, what is the problem? You want to point out that there are corporations that are mismanaged or even downright fraudulent that continue to receive public investment. So some of them are just criminal. They'll engage in bribery and corruption. They will have harmful labor practices, honestly, sometimes bordering human trafficking, or accounting and financial fraud. So they'll make up numbers, they will submit fake financials for regulatory purposes, and everyone therefore thinks they're a good company because their financials are lies. Second is they're often poorly managed. There are a lot of family businesses that don't have a lot of public accountability, and often, when you don't have a meritocratic method of appointing the next person in line, you might not get the best executives, the best presidents and vice presidents of the company. Third is they could just have a bad business model. So maybe they have a promising product, but then they're selling it very poorly. Maybe they're not in the right areas, and you just don't have a lot of faith in this company. You're telling everyone you have to get out of this company before it ultimately crashes because of a bad business model. Now, these are issues, and you want to make sure that the companies that exist within developing countries are not plagued by these issues. Someone might say, well, why does it have to be these investment firms? Why can't it be anybody else pointing out these issues and acting upon them? There are a number of reasons why. The first one is for governments. They are either complicit or actively benefit from these companies due to close relations with business oligarchs. So if they're engaging in bribery, then obviously a government won't regulate them. If these are the oligarchs that will fund their next campaign, then there's very little reason to want to crack down on them. Second, local investment firms who know these companies hold significant domestic power are more likely to invest than short sell. So if you know that this company is owned by a powerful family, has regulatory power, then your thinking might be, I should invest in them. I want to keep them afloat and put my money in them. And what that means is everybody and the kind of confidence that everybody has in these companies is a bit outsized because you believe these companies to be powerful and you invest in them, but it's a bit of a cycle. Now that they have a lot of investment, they continue to hold and wield significant domestic power. Third, being within the country makes you more likely to be a victim of retaliation. There is a chilling effect here. So this asks, why does it have to be a Western investment firm? Why can't it be some other firm within the country that is going to report an issue, a scandal, some mismanagement? That's because you're afraid. You don't want it to be that they take legal action against you. A lot of the time they will, for defamation, for libel, depending on if you attack the company, if you attack the individuals within the company, etc. So there's a bit of a chilling effect here. You have a limitation with the ability to exercise free speech precisely because of the power and hold that these companies have. Fourth, there's just also very little profit incentive to investigate into these issues without short selling. So regular news sites are probably unlikely to look into it. If it's a domestic news sites, you probably think it's quite a risk. Again, these are powerful individuals. You don't want to mess with them. But foreign news sites, which might not be particularly interested. So there's no pull to do the research work, to do the difficult stuff of looking into the bad practices of company, if you're either risking a lawsuit for your own domestic company, or if nobody's going to care because this is a company like miles and miles away and you're talking to Americans and Europeans. So this is the mix between you are safe enough as an investment firm and you are also have a profit incentive and a reason to actually want to do these things. What does activist short selling do? So again, you'll probably publish a detailed report highlighting some of the practices that we've mentioned that are quite bad. In the future, the company could face legal cases, increased government scrutiny, or simply be a bad business built on fake financials. So basically, you're telling all the investors, if you don't get out now, some bad stuff might happen to you. You might just lose all your money. Second, once they start to see a plummeting stock price, other investors start to withdraw investment, and there's kind of that knock-on effect. And therefore, this harms the ability for the company to have funds through selling stock. So if I am a company, I still own part of my stock. If I sell it, now that the price is much lower, I can't get more investment to my company. Or even from borrowing money once the reputation is damaged. So not just on the equity side, but even on the credit side, if all this information comes out, everyone thinks you're a sham company, it's much harder to borrow money. You can argue this is good, right? If they're committing crimes, if they are doing bad things for the environment, for labor practices, having less money to do those bad things could be a net positive. But why else could that be good? Number one, investors are protected from possibly larger losses in the future when these issues would have caught up anyway. So for example, if you believe that this was a bad business model and it would have crashed, the good thing is that you didn't let the stock price go up and up and up and up and then lead to that crash that would have a significantly larger loss in the future. Whereas now, maybe this isn't the full size of the company, maybe they haven't expanded to that amount, and therefore, yes, you will have investors taking losses, but better now than when the losses would have been so large in the future. Secondly, is you can now have competitors. So maybe this is an important product or service they're providing, but they're just a not very trustworthy actor to be able to do it. It might be good to have competitors spring up, and this happens in two ways. Number one is in status quo, competitors might have difficulty dealing with the significant investments that this company has. So you might just have less money, and therefore maybe they can't operate on a loss like the big competitor. Maybe they can't build the infrastructure to compete with them. But now, not only do you take away the advantage of having significant investments, but investors might still want to invest and therefore they can put it into other competitors. Third, you want to make sure developing economies become less dependent on such companies. So sometimes these companies don't just do one or two things, right? They become these massive conglomerates, these large family businesses. I think the Adani Group is a good example of that, where every industry has some form of this company's presence. And you don't want it to reach that point. You want to make sure that we don't get to the point that we solely depend on this company or a few companies for a significant amount of our economic development. Lastly, there's also a signaling effect. So even if you target just one company, every other company who thinks, wait, we can't get away with this anymore, we might get caught. This is not like before where we could just bribe the government to be able to get away with things. We have to reform as a company and become better. And so, not only are you targeting individual companies, there is a wider, more industry and even like financial market side effect of allowing these companies to do better and practice better things. Opposition. So some of these practices might be seen as bad by Western investors, but admittedly they have to be contextually placed. Like, I think in developing countries particularly, you have regulatory standards that are not the highest. So if you have a short selling firm that says it doesn't follow the proper ESG requirements, those are not, and for like sometimes reasonable like justifications, right? They might be very expensive. They might not be applicable to these countries. They might be significantly harder to implement in these countries without the proper capital, unlike in Western and European companies that they might see as their counterparts. So you have to be able to explain not all of the dangerous, or not even rather, not all of these quote unquote bad practices are necessarily inherently dangerous. They might end up becoming critiques from Western investment firms that might not be very fair towards developing countries. Second, um, push comes to shove, right? You have to talk about dirty practices. Sometimes they are necessary to operate, and it's a bit difficult because this is the landscape, particularly politically, that these companies operate in. And that's not their fault. To be clear, I'm not trying to defend anything shady here. It's more of to say that there are times when companies are put into a bad spot by regulators, by governments, and they might have to bend to their whims. They might have to make a political donation, etc. The question there is, why is it good to be able to directly harm that company when we are clearly missing the proper actor here? And so some of these practices obviously aren't great. It's not great, for example, to have bribery and corruption, and they are regrettable within these contexts. However, if the converse of that was that the company could not operate in that area at all, and people there would not be able to find work, it's a bit difficult then to be able to say that we should completely strip the company of any possibility of gaining capital. Third, things like family business are important in securing trust from locals, other investors, etc. Might be even a cultural thing in these areas that a Western investment firm might not understand. So perhaps the people within the family business are not the most competent, are not the most qualified for the job. At the same time, the family name could have tangible, meaningful things. These aren't great, admittedly, but the important bit here is to say, especially from the perspective of a Western investor, they might not have the best ability to discern what is just the nature of the landscape that they're operating in and what is particularly dangerous for these companies, and what are the bad things that they continue to perpetuate but don't really have to. So second, you want to talk about the alternatives. In the instance of the worst harms, like these are just actually criminal companies, there are many alternatives. You can talk about competitors, particularly. They're very willing to highlight flaws in business practices from each other. So if you know that your competing firm is engaging in crime, you really want to make sure that any lawsuit that might come their way will come their way. Any way for the government to crack down on them will happen, and you will be happy to provide information on that. You might be happy to provide whistleblowing on that. You might have employees that have been in both companies, for example, and can give information. Second, governments risk significant political scandals by being associated with these companies. So, yes, maybe you can take a political donation or a bribe, but if it's the absolute worst kinds of crimes that are happening, which a gov team has an incentive to point out, right? Because it's a convenient example to say we should take money away from these companies, then you're also more likely to have politicians that are not willing to associate themselves with these things. You can say that there are many other companies that might be willing to fund them. It's not reasonable for them to um, want to risk their political viability just for a couple bucks. Last thing is that local financial institutions also don't want the risk, right? They don't want to be placing their money in what are sometimes essentially Ponzi schemes, which is some of the companies that Hindenburg Research has criticized. They say that their dividend schemes are basically Ponzi schemes where they take in more investment and then give that investment to previous investors. And so, because you're a local financial institution who wants to avoid risk, you don't want to put your money on something that might eventually crash. What are the harms then of short selling? Quite a few things. Number one, these are companies that provide important goods and services to individuals. If they're a large company, they likely hire a lot of people and now they'll have to be laid off. And an important bit here is not just that these companies will shrink, it's the shock. So it's that it'll be often quite an instantaneous difference between when the stock price being high and the stock price being low. There are a lot of reasons for that, right? Number one is you have an inciting incident, right? Once that research report comes out, it's very unlikely investors are going to wait a week to think on the research report and instead price in the bad news that they just got about their investment and immediately sell off. The difficulty there is that shock, which is that you give people very little time to be able to adjust. So you don't have a gradual fall off, which might have happened where a company that competes with them springs up, where people might be prepared, where layoffs are not as instant, and there's greater time for the economy to adjust and find jobs for these people. And therefore, you will not have a very good amount of time to be able to prepare for the immediate economic shock this brings. Second, this can spook the market. I would say again, from the context of a Western investment firm that are culturally unaware, they might start to build stereotypes and think all the companies in this country are like this. All the companies in this country are fraudulent. They bribe their officials. They are not built on actual business. They have false financials. And therefore, once you take these as indicative of a country as a whole, number one, that's unfairly punishing companies that like work the fair way. But number two, um, that limits the ability of the country to attract foreign investment and capital when they might not have had a lot of foreign investment and capital inside the country to begin with, and therefore um, they will have difficulty starting up new businesses. They'll have difficulty hiring everyone in in the country and finding ways to be able to finance a lot of different economic activity that would have been possible if you had foreign capital. Third, this can discourage companies from going public at all. So an important thing to note is you cannot short a private company, at least not effectively, right? So the reason you can short is you have number one, a public market where you have like so many different investors that have money in this company. However, if you have a company that is private, where most of the shares or all of the shares are owned by a few individuals in a large family, you will not be able to do anything about that. And so, if you are a family company, for example, and you're thinking between should I go public and get greater investment from the market, or should I stay private, you might start to think I will stay private instead. Because now you have these Western investment firms that could shake up your stock price with very little predictability on your end. And you're left with um, very like small amounts of abilities to control your stock price. Given that, then that is possibly more dangerous because that ensures that there's no transparency for your company at all. If a company doesn't go public, they don't have to publish as many financial statements. They will have less public scrutiny because nobody has money in the game. Nobody has money invested in this company and therefore don't want to find out everything about the company. And so you might say that, well, yes, it would have been nice to have these research reports published, but what you are risking instead is all of these different companies refusing to go public. And therefore, you hurt the overall transparency of the financial market there to begin with. Last thing is you can also prevent risky, possibly bad business models from coming up that in the long term could have been viable but are killed in the short term. A lot of short sellers target burgeoning industries that, yes, still kind of shaky whether or not they're financially sustainable, but are possibly good products, and you could argue these are important things that we should have in the market, especially in developing markets, but will not exist if, again, if you're a short seller, you want it to be instantaneous, not only because an investor can't wait the week, but also because the longer that you wait, the harder it is to ensure that your investment would have profited. And so an instantaneous fall off would have been nice. Also, if you borrowed the stock, the person you borrowed it from or institution you borrowed it from is not going to be willing to wait a million years for you to give that stock back. So, really, what you do here is you have a short-term shock to a company's stock. And that could be bad when the viability of that company was long-termist anyway. So electric vehicles, meat alternatives, for example, are some of the common targets of these short-selling firms because they don't feel like they are going to be very um, sustainable. And to be fair, that's not all EV companies, particularly. I think a lot of EV companies are successful, but just select ones. And especially if you start one up in a developing market and compete with China, for example, it'll be very difficult to have that be financially sustainable. All right, I'll just end with some key questions for both teams. So these are things that I feel like I've touched on, but will be kind of the sticking points in this debate. Number one, how effective are alternatives to information? So, like I mentioned, yes, this is something an investment firm can do, but how likely can a government, a news agency, or any other actor who wants to expose the bad things a company does do it well? Because if on Gov, these alternatives are completely unviable, you maximize the benefit of information. While in op, if these alternatives are viable, then it's not clear why we need to risk the huge financial stress we are putting here, or the risk of the market changing in ways that are possibly less transparent, that could hurt the credibility of the country as a whole. Secondly, is how do these firms select companies? So you want to look into their possible incentives. And notably, you don't want to think about it from the perspective of just one investment firm. But again, if this becomes an ecosystem, if this becomes the norm where you have so many Western investment firms trying to short developing country stock, how do they compete? How do they differentiate from one another? And is that likely to be I don't know, a significant shift from just having had just one company do this? There aren't, I think, that many in status quo, at least not that many that specialize in this particular form of research. Lastly, is how bad is the contagion likely to be? Because I can imagine on Gov as it being targeted towards particularly bad companies, and at best, right, you have other companies looking at this and thinking, I have to fix how I handle the way I do business. Whereas with op, you can think of it like you're not just hitting one company, you are hitting the whole market. You are hitting one company and then everyone who depends on that company and the credibility of the country and so on and so forth. So these already have premises and intuitions borrowed from earlier on in the document, but I think this is something that will likely evolve throughout the debate, and you want to actively watch out for that. That's all. Thank you so much.